Hi, I'm Phil Grande of Philstake.com. Welcome to my YouTube channel, The Unfolding of the Market Crash. Well, since last Friday to this Friday, it has been volatile. Yields have been going down, tech goes up. Then yields go up, tech goes down. And sometimes when the yields go down, tech doesn't even move, and the banks move. That's a sign. That's a message from the market that's imploding from within. Now, let me show you another sign. Take a look at this chart. This is called a spear. See this? Now, what is that? Well, if you recall, back here, let's get my little arrow. This was the crash that we had in February of 2020, the pandemic crash. It ended in March. If you recall, we lost 22 million people. But the stock market, remember what happened to the stock market? Well, we're losing 22 million people working. It went up 113%. What the hell is that? How do you lose 22 million people and your stock market goes up 113%? What are you, nuts? It's called financial engineering. It's called QE. It's called dropping interest rates. Make sure those yields are down to keep boosting the whole S&P with a handful of stocks. Remember what I said to you. Think of this as a spaceship, a booster. And think of it as this way here, that you have 6 stocks. This is the booster. And there's 6 stocks in here. Those are your FANG stocks. Those 6, worth $8 trillion, 6 of the 500 S&P stocks. The other 494 stocks are worth $33 trillion. These drive the whole market. If you got rid of the booster, the S&P would totally collapse. Think about it. 22 million people lose their jobs, market's going up. That's nuts. It's because of the booster, okay? Now, this pattern is telling you something else. Something's wrong. What's that mean? Well, because for 13 years, they've been doing QE. For 13 years, they've been pushing the stock market up with low yields through QE. That has destroyed Main Street. Because remember, this is inflationary. And Main Street, unlike the rich, they don't have assets. They don't have stamp collections. They don't have artwork and valuable commercial real estate and all the different assets that they love when inflation's here, because inflation will make them even more wealthy. In fact, during this whole move, while 22 million people are getting laid off, the wealthy, the 1 percentile, their net worth went from 13 billion to 15 billion. 13 billion to 15 billion, to 30 billion, a 50% increase. Main Street wasn't that lucky. Their net worth only went up 4 billion. Why? Because they don't have the assets so when there's inflation, it destroys. Inflation destroys Main Street. It takes the value out of their dollar. It destroys their dollar. And then when you get to this point, as the rich are getting richer and the poor are getting poorer, this pattern occurs, which means we're getting so close now that Main Street's going to have to make a decision. Do I pay my car payment? Do I pay my gasoline? Do I pay my MasterCard? There's one of them I can't pay. That's what this means, this little pattern. Let me move on. Just like what happened, the housing crash in 2008. Now let's go back to a 6-month shot of this. What does this mean? More evidence that this thing is getting ready to crack. These are the lows, called higher lows. And see how they are holding above the trend? They're holding above trend until here. They went below trend. Then they juiced it up came back down, and this was Monday. Remember what happened on Monday? Monday, the market dropped 700, 900 points, okay? On Tuesday, the yields went down to 118. They got those yields down to 118 and points. They thought the big tech stocks were going to soar. They didn't soar. Something was wrong. So we're down 700 on this day. Tuesday we're up 900. Wednesday we're up 200. Thursday we're about break even, a couple hundred, and then today. So this is key. This is key, this little point here, okay? It's telling you that something is amiss. Something else. You see this here right before the crash in 2020? See this pattern? Another arrowhead pattern and a crash, didn't it? Look at this. Same pattern today as it was back here in February 2020. So this is what could happen right here. So what's going to drive this market? Yields. Now remember what I told you. If you go back and you take a look at back in 2020, back here, the yields were at 85 basis points, not even 100. Finally, we shot up to 172 basis points in April. We reached 125 basis points here. We shot up to 172 in April. Now we're back to 125. So now they got to make a decision, the Federal Reserve. Are they going to push the banks up, or are they going to push the tech up? If they decide to raise rates, yields, and push the banks up, that's going to be a major problem for tech. If they raise yields, it's for the banks to go up, the tech will go down. If they lower yields for the tech and they lower yields for tech and the big tech goes up, it continues to destroy Main Street even more over the past 13 years. So they have a decision to make. So let's go take a look what they got to look at. So if you go look in the last few days here, let's go back to the Qs. Why is this important? For you people who are in Apple and Google and Microsoft, all these stocks, what do? Well, here's the thing you got to do. See the Qs? That's the NASDAQ 100. If you notice how they went up in the last 5 days, but remember, they're going up now on higher yields, like the banks. That doesn't make sense. And here's the big problem. Look at the volume. The volume is decelerating. It's below the yellow line, which means it's below average volume. That's very bad by divergence. Here's what we need. In order to go back and feel comfortable buying, keep adding to your positions on your big tech stock, we need this guy to break out. It's got to break out, okay? And if it breaks out, then you're going to be fine. But it's not enough just to break out. It's got to break out like this. It's got to hold for 5 days. And down here, look over here, the volume has got to be above average, above this yellow line. If that doesn't happen, if that happens, then let's add to, we have Microsoft. I'll add to Microsoft. Okay, if that happens, I'll add to, remember we got into Microsoft, and we also have Intuit. And we'll add to our Intuit. But until I know that we got proof that this can sustain itself for 5 days and on big volume, if that doesn't happen, then I'm going to be very, very careful, because that means this big tech can drop big time. It can drop big time on higher yields. It'll drop, right? So again, the test. If you want to continue with your Apple and with your Google and with your Microsoft, just like we will, we'll continue buying it only if the Qs break out and hold for 5 days and the volume is above average. In the meantime, we're going to reduce our positions in our tech stocks, and we'll see what happens in the next 5 days. And guess what? Put your stops in. Reduce and put stops in until the test of Q is done. We need above average volume with the Qs. Otherwise, this whole thing can break down. Okay? All right. Now, hope you like this. Hit like, share, and subscribe. Please listen to my radio show on my YouTube channel, every day. And join the gang free for 10 days. Go to philsgang.com. sign up for Working Investor. You get the free chart like you see right here, color-coded chart, and you remember for 10 days, all right? This is a very critical time. This is when you should at least try for 10 days free. Very critical the next 10 days, believe me. See you in the charts.